When it comes to investing, we have to accept volatility, embrace volatility. Volatility is our friend. We have to stay away from risk. Over the last weeks, the market was down, what was it, 18%. Now it's again up. So huge volatility. And whenever you look at markets, there is always some risk ahead. But let's listen to Charlie Munger and what he says about volatility.
How worried are you by the declines in the share price of Berkshire Hathaway, the difficulties the company's in?
This is the third time that Warren and I have seen our holdings in Berkshire go down top tick to bottom tick by 50%. I think it's in the nature of long-term shareholding with the normal vicissitudes in worldly outcomes and in markets that the long-term holder has his quoted value of his stock go down and then by, say, 50%. In fact, you can argue that if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get.
And if we just look at Berkshire, here from 1998 it was down, I think, 50%. Then here it was 40%, 50%, sorry. Here we had again a 30% to the bottom, 25. Here it was 25% down. So that is a normal given investing, and you have to accept, even take advantage when the market gives you a fair price. That is why we look at the market to see whether it will offer us a fair price for a great business. And now let's discuss what is risk and what is volatility. Risk is defined from Investopedia here, how the chance that an outcome or investment's actual gains will differ from an expected outcome of return. Includes the possibility of losing some or all of an original investment. How it's measured? It's measured by volatility in finance, which is completely wrong for value investors. Standard deviation is a common metric associated with risk. Provides a measure of volatility of asset prices in comparison to their historical average in a given time frame. Volatility, it's not risk for long-term investors. Because if we look at Berkshire, yes, the stock was down 50%, 50%, 30%, so high volatility. But especially after the high volatility, it was the best time to buy Berkshire. So we have to separate volatility from value. Here I told you it was a P ratio of 10, and you will rarely find Berkshire at a P ratio of 10. I made a video on March 2020 how you will rarely find Berkshire this cheap. That is value investing. So we embrace volatility, but we don't see it as risk. And now I see a lot of risk out there, especially if there is a recession, but I'm sure you're going to eat. And that is why I have Archer Daniel Midland here as the lowest risk compared to others when it comes to investing. Why? Because now if you look at the stock price, ADM went from almost 100 to the current 44. Thus people say this is extremely risky from a volatility measure, but the price is down and the price is now close to the long-term food boring business trend. It gives you a 4.5% dividend yield. The dividend has been increased for the last 50 years, will likely continue to be so. So they make money, you have to eat no matter what, and that is the risk and reward. That yes, if soybean prices drop of this or that, maybe there will be more volatility next year, the stock price might be a little bit weaker, but over the long term, the dividend and the growth and inflation will give you the returns. So to put this into a perspective, when it has short-term volatility, the market doesn't like it, but for long-term investors is irrelevant. Often it is more of an opportunity. Long-term outcomes is what we focus on. With some businesses it's more or less predictive. Volatility is impossible to predict, it is our central concern. Emotions, we have to take advantage of other people's emotions, irrational selling that gives us the low prices for the businesses we want to accumulate. And we know that by looking at research, knowing what's going on, knowing the long-term risk and reward, because the market is focused on a narrow one-year frame. And that's what separates traders from long-term investors. Volatility is the friend of the true value investor. And going to my PhD, I have looked at various fundamental factors and I have made the risk-return factor, and the more you go in time, I think this is 12 quarters, the more it explains stock market price changes. So fundamentals, the more you go in time, are explaining long-term returns. In the short term, you cannot find explanations because it is too volatile, too crazy. So how to separate volatility from risk? Berkshire will likely make 40 billion next year. If there is a recession, 30. So that is the small volatility in the earnings that give you the rewards. However, the stock price can go anywhere. The key is, what's the price I'm paying for those returns? P ratio 25, in my opinion, is a little bit risky. If it goes to 15 from the current level, that would be, again, a great bargain given Warren Buffett's cash position. And it can happen, it was here, maybe it will go to 400, 350 in a recession, panic or whatever, which would make it cheap. Similarly, as we discussed to Archer Daniel Midland's, if it goes even lower, it becomes an even better bargain, and then you wait for the next food cycle, and then you decide whether you're going to sell, trim the position or not. How to know whether something is value or not? This is my research platform. Everything is focused here, concentrated, that is on a need-to-know basis in the first thread here. That's it. However, look at how much research we have done over the last 7 years to get to a concentrated value portfolio over time. So we have done a lot, plus what we share here on YouTube. This is value investing. Feel free to check it out, 21-day money-back guarantee, research platform. I'll see you in the next video.